on the 24th of February 2019. This week in economics, our macroeconomics report that we do weekly here at WBRN Radio and on the Bostonred Network. This is our Numbers Man division. When we originally started the program, the program was called the Numbers Man Show. We're trying to do more integration of all of our programs here at WBRN radio and internet radio station and the Bostonred Network. So thus we have the political program of Bostonred, and we have also Bostonred on the World, which has an international focus, all about sports, which is self-explanatory. It's about sports, and a Numbers Man here from the economic field. And also we have the open source report, which is covers open source, libre, free software, and hardware and security issues in cyberspace, and it's now a broad thing of cyberspace. We talk about cyberspace, we talk about operating systems, we go into mobile phones, the Android part of it, and the iOS, which is the Apple part, and in between where the industry is going. And in 2019 we'll have a new program over on the Numbers Man section called this is just a working title, the Economics of IT. But let's get to this week. We don't have the data that we normally have, but we'll start out with some PMIs, and then we'll go to Warren Buffett and Berkshire Hathaway and do a little perusal of his annual letter covering 2018 to the stockholders of Berkshire Hathaway. This is Warren Buffett. And what the Fed is up to. The Fed is looking now, redoing some things. Low inflation, and we talked about that before here in some of the models that we have been running at Currency Analytics in terms of the possibility of deflation. Deflation, they've had it in Japan, very, very difficult to deal with. Inflation you can deal with, but not de-inflation when prices become very low. And we'll talk about the yield curve, how it got inverted. And there you have a big quagmire and what's going on. The Fed, of course, winding down its holdings. They're called quantitative easing. That is winding down. What will happen to interest rates? We feel that at this stage in the economy, that perhaps 2 additional rate hikes is necessary. Now the Fed is continually reevaluating that. You have employment numbers for an industrial capitalist economy very, very high, around 4%, 3.9, 3.11, whatever. But at the same time, we're starting to see some cracks in terms of various sectors, automobiles, the housing sector is showing it. So we'll go to this PCI. This is from Market Economics, and they have the PCIs. We'll look at the U.S. and we'll also look at the EU Union. Now we'll do the U.S. first. This is the flash PMI for the U.S. Service providers, up in quickest rise in private sector output since June of 2018. Now the index is at 55.8, and it was 54.4 in January, an 8-month high. The flash U.S. Service Business Activity Index is at 56.2. It was 54.2 in January. The flash manufacturing PMI at 53.7. It was 54.9 in January of 2018. The flash manufacturing output index at 53.7. It was 55.7. Private sector output growth regained momentum in February with robust upturn in service sector activity, more than offset a slowdown reported in manufacturing. Survey respondents noted that improved domestic economic conditions had underpinned a sustained rebound in new business so far in 2019. Resilient client demand also helped to boost job creation in February, with the private sector payroll numbers rising at the fastest pace since February. Now, this is the IHS Market Services PMI, a robust accelerated increase in service sector output was the main reason for strength signaled by survey respondents in February at 59.2, up from 54.2 in January. Seasonally adjusted flash U.S. service PMI business activity index indicated that the sharpest upturn in activity since June of 2018. Service providers commented on higher levels of business and consumer spending during February, as highlighted by strong overall expansion in incoming new work since, very important factor here, since last September. Latest data points to the steepest increase in backlog work for just over 4 years. The greatest pressure on business capacity also leads to rebound in job creation to its sharpest for 5 months in February. On a less positive side, the input cost inflation acceleration for nearly 2-year low seen at the start of 2015. Higher operating expenses, improved demand conditions contribute to another solid increase in average price charges by service sector firms. Now, the PMI, in contrast to stronger trends reported by service providers, the latest survey signals a loss of momentum across the manufacturing sector. Adjusted for seasonal influences, the Manufacturing Purchases Index PMI dropped to 53.7 from 54.9 in January. This is in February. Anecdotal information from survey respondents cite a small patch for client demand, partially linked to uncertainty across manufacturing supply chains, concerned about global trade outlook. There were also some reports that adverse weather conditions had disrupted production schedules in February. Despite slowdown in production and a new order growth, the latest data signals another solid upturn in manufacturing equipment. However, input buying continues to rise at a relatively strong pace in February, which adds to signs that manufacturing remains firmly in expansion mode. Let me get the rest of this. Meanwhile, input price inflation eased for the fourth month running and reached its lowest since August of 2017. Survey respondents still note that trade tariffs have pushed up the cost of imported products. A comment here from Tim Moore, he's an associate director there. February's data provides a positive signal for quarter economic growth, with U.S. businesses reporting the fastest output expansion since the middle of 2018. Service sector firms lead the way, supported by solid improvements in business and consumer spending. Private sector payroll numbers increased to the greatest extent for 5 months. Historic comparisons suggest that the latest survey data are indicative of underlying economic growth rate of around 2.5%. The Feds talked about the same thing, and not the 3% that the administration talked about. Although the PMI is designed to monitor private sector companies, so far as the impact of government shutdown may not be fully captured. The main worrying development was of a loss of momentum reported by manufacturing companies in February. Businesses that experienced a soft patch for production cited a range of factors, including back growth, including adverse weather conditions, worries about the global economy. Needlessly, relatively strong domestic business conditions mean that U.S. manufacturers remain on a more positive trajectory than recent downbeat production trends are signaled there. So we'll look at the European sector. Perusal of it. Flash Eurozone. This is Eurozone. PMI was at 51.4. It was at 51 in January, 3-month high. The service PMI activity index at 52.3. That is up from 51.2 in January. Eurozone manufacturing output index at 49.2 is down from 50.5 in January. That is a 69-month low. The manufacturing PMI was at 49.2. This is in the Eurozone, and it was in January 50.5. Although output across the Eurozone's private sector increased at a slightly faster pace in February, the rate of expansion remains mute. Moreover, the manufacturing sector weighted on overall economic performance, the same as in the U.S., falling into contraction during the month. The market zone composite PMI posted 51.4 in February. That's up from 51 in January. The flash estimate is based on approximately 85% of the final numbers of replies received each month, despite the quickening from the 5.5-year low seen at the start of the year. The expansion remains modest. Overall growth was centered on the service sector, where activities also rose at the fastest pace in 3 months, improving picture in Germany and sustainability in France. On the other hand, the Euro area manufacturing production decreased for the first time since June of 2013, while business activity rose at a faster pace. There are remaining signs of demand weakness. New orders dropping for the second consecutive month. More evidence in Germany's service providers in the Eurozone's largest economy posted a marked and accelerated rise in activity on the back of a pickup in a new business growth. On the other hand, industries moved into contraction territory, with output down for the first time in almost 6 years, and new orders decreasing sharply, and continued reports of issues in the auto sector. There's also signs of stability in France, despite reports of lingering disruptions caused by the yellow vest Gilets jaunes protesters. Service activities decreased only fractionally, while manufacturing output stabilized, following 2 months of decline. Outside the two largest Eurozone economies, output was only modestly shown for the second month running to weakness, the weakest since November 2013. And output manufacturing was the main source of weakness in new business. Manufacturing new orders decreased to the greatest extent in 6 years. Employment remains a bright spot in February, in spite of retractions in both new orders and outstanding. Business staff levels increased at a solid pace that was faster than at the start of the year. The rate of job creation quickened in the service sector and held steady in manufacturing. The data on business sentiment also provided cause for optimism with confidence regarding the 12-month outlook. There were signs of inflationary pressure warnings midway through Q1 of the year, first quarter. The rate of input cost inflation, same as in the U.S., softened a bit, actually rose in the U.S. Output prices also rose at the slowest pace in 18 months, softer Inflation was registered across both monitored sections. The divergence, in a performance between manufacturing and service sector in February was economic outlook, raising the risk of inversion has consequently dampened demand, investment, and spending. The weaknesses are being led by manufacturing, same as in the U.S., while the entrance of the first downside mid-2013 with factory orders booking deteriorating at an increased rate. The rate of contraction in the goods producing sector will likely worsen in the coming months. Solid domestic demand in many countries, notably in Germany, continue to help support service sector growth and offset downturns in manufacturing. However, the overall service sector growth remains relatively morbid there. So that is what we have from the market people. And I don't think we have anything for the UK. We had something for France, but I won't go into France. No, well, let's see. We won't go into Australia. We could. The Nikkei, these are all on the 21st. We'll go ahead and do the Nikkei manufacturing. I almost did it in Japanese here. Okay. Flash manufacturing PMI fell to 32-month low at 45.850 from 50.3 in January. Deterioration in manufacturing sector turned negative for the first time since November of 2012. Today sees the latest public release of the Nikkei Japanese Manufacturing Purchasing Managers Index, published on a monthly basis. There. And let's see, they made it short and sweet here, actually, as we'd say. Commenting on the manufacturing survey data, Joe Hayes, an economist at Market, which the company survey says, survey data from Japan's manufacturing sector have into a negative territory in February, reflecting a sharp reductions in demand and production, although the initial Q4 estimates revealed a bounce back in economic activity. PMI suggests underlying business conditions are unfavorable. This was further highlighted by output expectations turning negative for the first time in 6 years. This is in Japan. For the first time in over 6 years, which comes as no surprise given the international business headlines Japan manufacturers are facing, such as a Chinese slowdown. The global growth cycle losing further steam unless the service sector activity can be offset there to be the weakest one out there. So this is in Japan, not very good news there. From Warren Buffett here, we'll skip around in the ship. Buffett says focus on the stock price of Berkshire Hathaway. He's on it. Said in his annual letter to the stockholders of Berkshire Hathaway, the conglomerate stock price will over time provide the best measure of business performance. In conjunction with that, he plans to de-emphasize the book value, measuring assets minus liabilities. That is a change. The vagrancies of accounting rules means that the gauge has lost relevance it once had. The shift is something of a retreat from Buffett's decision for preaching patience and long-term thinking for investors and shareholders. The antithesis of what stocks often represent. The Ecnomics has helped make him the what is now the third richest in the world at $85.9 billion, according to Forbes. For nearly 3 decades, 30 years, has led the stockholder letter with discussion of book value He has also long included tables comparing the annual changes in Berkshire Hathaway's book value and the Standard & Poor's 500 index into dividends. In the December 31st, book value per share had gained 1,918,899%, or 18.7% per year since Buffett took over the company in 1965, compared with the S&P at 15.9%, or 9.7 annually. Berkshire has outperformed last year too, up 0.4% compared with a 4.4% drop for the index. He says he did this because Berkshire Hathaway shifted towards operating large business such as the energy, rails, and Geico, that's the BSF rail, was widening the gap between this intrinsic value and book value. While stock prices can be volatile, he says he said they and the intrinsic value remain invariably convergent over time. Stock's also done well under Buffett. We won't get into all that. First, he said Berkshire's major value is now its operating units, and he and the vice chair, Charlie Munger, we had him in the last, expect a reshaping of its assets mix to continue. He said accounting rules require them to value its business as far below the current value. Finally, he said he's likely to buy back significant amounts of stock in the future. A lot of people are doing that. The book value per share fell 7.1% in Q4. He said these holdings will likely grow in 2019 because near-term prospects for acquisitions are not good. Now let's get to the actual report itself, and we will append this. We will not read it all. Berkshire earned $4 billion in 2018, utilizing generally accepted accounting practices, commonly called, the GAAP. The company's figure was $24.8 billion in operating earning, $3 billion in cash loss from impairments of intangible assets, and rising amongst entirely from equity interest in Kraft Heinz, a $1.28 billion in real capital gains from the sale of investments, and a $20.6 million loss from reduction in the amount of unrealized capital gains. The new GAAP requires us to include in the last emphasized in earnings emphasized in 2017. Vice Chair Charlie Munger nor I believe the rule to be sensible. Rather, both of us have consistently followed with Berkshire Hathaway. Market-to-market change would produce what I described as wild and capricious swings in our bottom line. The accuracy of that prediction may be suggested by our quarterly results from during 2018. The first and fourth quarter reported a loss of $1.1 billion and $25.4 billion respectively. In the second and third quarters, reported profits of $12 billion and $18.5 billion. In comparing the contrast of these gyrations, the many businesses that Berkshire owns delivered consistent, satisfactory operating earnings in all quarters. For the year, these earnings exceeded the 2016 earnings of $17.6 billion by 41%. In fact, the annual change in book value, which makes it far well appearance on paper, it's a metric that lost its relevance. It once had. These circumstances have made that so. First, Berkshire has generally morphed from a company whose assets are concentrated in marketable stocks into one whose major values in operating businesses. Charlie and I expect the reshaping to continue in an irregular manner. Before moving on, I want to give you some good news, really good news, that is not reflected in our financial statement. It concerns the management changes we made in 2018. Jermaine was put in charge of the insurance activities, and Greg Abai was given authority over all of our operations. These moves were overdue, and Berkshire is now far better managed than I alone was supervising the operations. Jad, S-A-J-I-T, and Greg both have rare talents, and Berkshire blood flows through their veins. We'll see. So he's gradually moved out of the picture. That's Warren Buffett. Investors who evaluate Buffett sometimes are obsessed on the details of how many and diverse businesses our economy on our economy tree, so to speak. Analysis of that kind can be mind-numbing, given that we own a vast array of specimens ranging from twigs to redwoods. Anyway, fortunately, it's not necessary to evaluate each tree individually to make a rough estimate of Berkshir's intrinsic business value. That's because our forest contains 5 groves of major importance. That's interesting how he does this. 4 of those groves are differentiated clusters of business and financial assets that are easy to understand. The 5th of our huge and diverse insurance operation delivers great value to Berkshire. Before we look more closely at the first 4 groves, let me remind you that our primary goal in the deployment of your capital is to buy evilly managed businesses. He said this before. Despite our recent additions to marketable equities, the most valuable grove in Berkshir's forest remains the many dozen non-insurance businesses Berkshire controls, usually with 100% ownership, neither with less than 80. The subsidiaries, $16.8 billion. That brand of earnings is a far cry from the frequently taunted Wall Street bankers and corporate CEOs. Too often their presentations feature EBIT, data measuring redefined earnings to execute the value of two near costs. For example, management sometimes asserts that their company is stock-based compensation should be covered as an expense, and that is in the computer industry. Abraham Lincoln once posed the question, if you call a dog's tail a leg, how many legs does it have? Or then you answer this query, because calling it long tail doesn't make it one. Anyway, Charlie and I do contend that our acquisition-related amortization expenses of $1.4 billion, it's detailed here somewhere, in current Berkshir's $8.4 billion depreciation scale there, and we'll give some of this year ownership. Companies: American Express 17.9%, Apple 4.4%, Bank of America 9.5%, Coca-Cola 9.4%, and Wells Fargo 9.8% based on current rates there. Our investors paid us, investees paid us dividends of $3.8 billion last year, a sum that is increased, that will increase this year in 2019. A third category of Berkshire's businesses, our portion of after-tax operating earnings for these businesses, 26.7% for the Kraft Heinz, 50% of Berkshire of Banker and Electric Transmission Texas, 30.6% of Pilot's Flying J. Our Fort Grove, and it's interesting, he's turned these into trees. Berkshire held 112 billion at year's end of U.S. Treasury notes. Our other cash equivalents around 20 billion in miscellaneous fixed income instruments. We consider it a portion of that stash to be untouchable and have pledged it to always hold at least 20 billion. Berkshire will forever remain a financial fortress. In managing, I made expensive mistakes out of commissions and will also miss many opportunities since which is obvious to me. Disappointing reality means that in 2019 we'll likely see us again expand our holdings. Marketably, equities, we continue needlessly there. Charlie and I, let's see, I am the youngest. That prospect is causing my heart and Charlie's to beat fast. Well, Charlie's 94 and he's 88. So there you go. Some repurchasing going on here. I won't really go into it. You can read it. For 34 years, our management decisions at Berkshire have been from the viewpoint of stockholders who are staying, not those who are leaving. Berkshire, in fact, may be the only company in the Fortune 500 that does not prepare monthly earnings reports or balance sheets. I, of course, regularly view the monthly financial statements. Moreover, Berkshire has no company-wide budget, although some of our subsidiaries find one useful. Over the years, Charlie and I have seen all sorts of bad corporate behavior, and no doubt he has. Non-insurance operation from lollipops to locomotives. Look at Berkshire here, beginning with the economic reality. Like it or not, the U.S. government owns an interest in Berkshire's earnings of size determined by Congress. In effect, our country's Treasury Department holds a special class of our stock. They call this AA shares. Well, that suggests the performance of our non-insurance business. Two towering redwoods. I can't get over this one. BSA, that's the rail company, and Berkshire Hathaway Energy. They own 90% of that. Combined, they earned $9.3 billion before taxes, up 6% for the year. And I guess I'm getting through this. In most cases, funding of businesses come from two sources: debt and equity. At Berkshire, we have two additional arrows in the query to talk about. We use debt sparingly. Many managers, it should also note, will disagree with this policy, using other people's money. On level equity capital is a different story. Berkshire's of $349 billion is unmatched in corporate America. By retaining all earnings for a long time and allowing composite interest to work its magic, we amass funds that have enabled us to purchase and develop valuable groves earlier described, and we follow the 100% payout policy. We still work with $22 million, in which we began in fiscal 1965. Beyond using debt and equity, has benefited in a major way from two less common sources of corporate funding. The largest is a float. I've described, and so far these funds are recorded as a huge net liability on our balance sheet, but what's been more utility to us than the equivalent amount of equity. Anyway, this is Geico, and Tony nicely joined he's up there too. Geico in 1961. He was 18. I met him in the mid 1970s. At that time, Geico, after a 4-decade record of expansion, outstanding underwriter results, and recent installed management, had grossly underestimated the loss and subsequently underpinning there. There was no less than 2.3 million of them will expire anyway. In 1976, Jack Bryant was bought in to rescue Geico. Within a few months, Berkshire bought 1/3 of the company, and I guess Byrne was still there. Let's fast forward 17 years. In 1993, Tony Nicely was promoted to CEO. At that point, Geico's reputation and profitability had been restored. In 1995, after Tony re-energized Geico, Berkshire Hathaway made an offer to buy the remaining 50% for $2.3 million, and the little whatever it is in the commercials continued on. Here's a list of our 15 common stock investments that year-end had the largest market value. We exclude Heinz, Kraft Heinz. Anyway, this is some of what they have. They have 17 percentage of company owned, 17.9 at American Express. At Apple, they are lessening this, incidentally, at 5.4. Bank of America Corp at 9.5. Bank of New York Mellon at 8.8. Charter Communications at 3 there. Coca-Cola at 9.4. Delta Airlines at 9.6. Goldman Sachs at 4.9. JP Morgan Chase at 1.5. Moody's Corp at 12.9. Southwest Airlines at 8.7. United Continental, that's at 8.1, and U.S. Bank Corp at 9.1. Wells Fargo at 9.8 out there. So this is some of the things that they own. In our opinion, they should make adjustments in Apple, and they should make adjustments in Coca-Cola. They stood at 9.4% there. They don't mention IBM. I guess they... Anyway. Maybe they've disappeared. American Tailwinds on March 11. They will be 77 years since I invested in an American business. That year was 1942. I was 11, and I went all out there at $114.75 in shares in City Service preferred stocks. Anyway, during the 77-year period since 1942, the United States has grown from 4 million people, about a half of 1% of the world's population, into a powerful country on earth in the spring of 42. It faced a crisis there, no doubt about that. I made my purchase. The nation expected growth. It was more than 4 million people. I'm not sure what that number came from. Anyway, he's talking about his $114.75. Well, that was my stake would have grown to be worth $606. I guess he kept it in January 2019. That's the available data they had. In a no fee. Oh, I see what he's saying here. Anyway, not sure how he got into that one. Our country, almost unbelievable prosperity, has been gained in nonpartisan manner since 1942. We've had 7 Republican presidents and 7 Democratic presidents. The year they served the country. Continued at various times with longer periods of virtual inflation, a prime rate of 21%, several controversial and costly wars, the resignation of a president, a pervasive collapse in home values, and a paralyzing financial panic, and a host of other problems, all endangered scarce headlines, and all are now history. In 1788, to go back to our starting point, there really wasn't much here except a small band of ambitious people, embryotic governing framework, and at the turning agreement to reality date, the Federal Reserve estimates household wealth at $108 trillion. And almost impossible to comprehend. Remember early in this letter how I described retaining earnings as having been the key to Birch's prosperity. It has been with America. It's also been America. The nation's accounting comparable items is labeled savings, and we sure have it. Our forefathers, have instead consumed all their products, and there have been no investments, no productivity gain, no leap in living. If our forefathers had consumed, Charlie and I happily acknowledge that much of Bertha's halfway success has simply been on a product and what they call the American tailwind. It is beyond arrogance for American businesses or individuals to boast that they've done it all along. This is his thing at none other than DJ Trump. There have been many countries around the world that have bright futures, and about that we should rejoice. Americans will be more prosperous and safer if all nations thrive. At Birch, we hope to invest significantly sums across borders. In our next 77 years, however, the major source of our gains will almost certainly be provided by the American tailwinds, and we are lucky. And what have simply been the product of what we call American tailwinds is beyond the arrogance. Anyway, this is very interesting how he closes out the annual meeting, of course, and we always cover it. Will be on May the 4th in Omaha, Nebraska. If you can't join us, attend. It's always on Yahoo there. And Andy Severa and his Yahoo associates do a very good job. Charlie and I love the job. So we'll see them on May the 4th, 2019. And we won't have time for that. And this is a speech given prospects for inflation in a high-pressure economy. Is the Phillips curve dead, or is it hibernating? And this is the discussion there, and remarks at the Monetary Policy Conference in New York, as prepared for Liberty on the 22nd, been 2 days ago. The Phillips curve is a connective tissue between the Federal Reserve's dual manual goals, of maximum employment and price stability. Despite the regular declaration of its demise, the Phillips curve has endured. It's usually both the empirical basis for forecasting and for monetary policy analysis. This is a paper here by Peter Hooper and company. Here provides an in-depth analysis of key aspects of inflationary dynamics in the U.S. and how they have changed. This study is in particular timely against the backdrop of emerging consensus that the Phillips curve has been nearly flat, and if this is true, it would fundamentally alter the employment inflation trade-off the Fed confronts. There's a lot to say about this paper. If it synthesizes existing research, new analysis, and bridges the study of wages and prices. Too often these are studied in isolation. I agree there. But the most significant, as someone who has discussed the paper that reaches the century mark in paper count, this year's paper comes in a relatively sliver, 65 pages. I hope this represents a durable structural shift and isn't merely a reflection of the fact that this year's paper has 3 authors rather than the usual 4. The paper covers a lot of things. First, there's evidence of asymmetric effects of unemployment at both price and wage inflation. There's a very low rate of unemployment leading to disproportionate large movement in inflation. That is, the Phillips curve is very alive in a very tight labor market. Second, they can find that the dynamic of price inflation has changed in important ways. Specifically, it's become less sensitive to the business cycle and less prevalent. Finally, they draw the policy condition that the Fed policymakers should not be complacent about the possibility of resurgence of inflation in the context of a tight labor market. In my remarks, I will discuss two issues. First, that the price inflation dynamics and has changed significantly in recent decades. I will argue that a number of structural factors have contributed to the appearance of the flattening of Phillips curve, and that modified formations that account for these changes display little sign of the Phillips curve's flattening. Second, I will turn to the issue of anchoring of inflation expectations, the need for the Fed to be vigilant in maintaining the anchor in the right place. Has the Phillips curve changed, or is it a trick of the data? Throughout the paper, use reduced the HMS of the Phillips curve, regression at a basis for their analysis. For my remarks, I will simply simplify the specification and assumption that the inflation rate depends on the unemployment gap, and that the variant, therefore, for logs of inflation consistently. I have dropped the importance of price and inflation expectation terms. Overall results of the core personal consumption, that is PCE, price inflation, using a simplified specification, are quite similar to those reports. The full example, that's in 1961 to 2017, estimate the coefficients of using the core PCE price inflation rates are reported in the first column of the upper table. The second column, and I won't go in that because we don't have the table here. The so forth and so on. Interestingly, I find evidence in the early pre-1980s sample that suggests that inflation was, if anything, more sensitive to unemployment gap when the unemployment was high rather than when it was low. Although these estimates are imprecise, this pattern is the opposite of the claim by HMS, which relies on a full sample estimate to draw conclusions. This also runs counter to the historic narrative about the 1960s and the damage of the red-hot labor economy. I will not dwell on this, but this is a reminder that findings of non-linears in the Phillips curve are often not robust. That apparently breaks down in the simple price Phillips curve in the last 30 years reflects a number of structural changes. The Federal Reserve's success are re-anchoring the inflation expectation at a low level can explain the decline in inflation. Persistence is seen in the data. However, the role of well-anchored expectation in the flattening the Phillips curve is not obvious. Several usual suspects come to mind, including the effects of supply stock and the increased globalization of goods markets, simple chains and changes in market structures for consumer goods. This is Alberto Cavero has shown how Amazon and other, I think we had that in one of our broadcasts, other retailers have fundamentally changed the price dynamics for consumer goods, with prices changing more rapidly and more affected by exchange rates. In today's globalized and rapidly changing economy, standard reductions from the Phillips curve model that focus primarily on demand-driven movements in inflation are less relevant. Other factors beside it, and I'm going to skip around here a little bit because this is a bit long. Implications for monetary policy framework, the risks of inflation expectations, anchor slips towards a sure call for reassessing the dominant inflation targeting framework. A number of alternative frameworks and strategies have been proposed that could hold a promise of better achieving inflation goals there, and the faster inflation anchor. The Federal Reserve is undertaking a review of our policy frameworks this year, a topic for Federal Reserve Vice Chair Clarendon to discuss. So we'll append this on, and hopefully we'll look at this paper here and put it on. I'm not sure if we can. Let me I've already covered the Warren Buffett here, and we've talked about it. Let's go to BBC and do the numbers. I need to look at our time. Okay, well, we where we usually are. Anyway, we'll do the numbers here, and from the BBC this time around. The FTSE at 0.62, all the positive there. That's FTSE 100. The FTSE 250 was at 0.71. In Amsterdam, they were at 0.15% there. In France, at 0.38%. In Germany, the DAC at 0.30. Eurostat at 0.21. In Madrid, they were at 0.51. And in Bombay, in Bombay, they were in the negative 0.07%, and Hang Seng was at 0.65%, and the Nikkei at a negative 0.18. In New York, we'll find them in a minute. The Dow at 0.70% there, and the Nasdaq at 0.91%. And in Chicago, they were at 0.64. And commodities, Brent crude was up 0.7 at $67.82. We don't have anything from the people in West Texas. Got a lot of things missing here on the Forex. Gold now unchanged at $1,335.05. And I guess that's what we got. Yeah, pretty much the same thing. We'll go to Europe here. This is from CNBC. The FTSE, did I miss anything here? No, I guess not. And to Asia, everybody's in Shanghai. They're plus 1.91% in Shanghai. And the ASIAX 2000 at a 0.46. And the Kopi was up at 0.08% there. So those are some of the things going on here. And oil pricing, Brent crude, yeah, we didn't get anything new on that one. And gold, I think we're going to get probably about the same thing on that. Silver was up 0.35. Yeah, these are just percentages here. Not really going to help us at all. This is from CNBC. 10-year Treasuries at 2.654, and it's a long list of bonds here where they were. Japanese bond, well, didn't get anything done at all. So that is CNBC. See if we can snatch. Yeah, we got them all, I suppose. But we're going to get. Yeah. Wheat was down $1. We always have to look around to see what else we can find here. European markets. I think we got most of these markets here. Yeah, in Spain. Yeah, we did. In Malaysia, they were down 9.26. In Taiwan, 3.39. They were in the positive there. And let me see what else I can snatch out here that we didn't get before. We got Shanghai, we got the Nikkei. I think we got everyone that we could literally get. So this will do it for us. Those in business, make next week a positive one. We'll have more economic data, better data sets next week. The Fed chairman, Mr. Powell, will be doing these Humphrey Hawkins hearings in the Congress, both the Senate and the Financial Oversight Committee. Representative Waters, who is now, 79, 80 years old? Anyway, she will be presiding. She's from South Central Los Angeles. Incidentally, the Hawkins part of the was named after Senator Humphrey, the late Senator Humphrey of Minnesota, and Augustus Hawkins, who used to represent South Central Los Angeles like Maxine Waters does now. Anyway, with that, from WBRN Radio and the Bostonred Network, on the 24th of February 2019. Good day.